So, Josh Stein, DFJ, the title of this session is What Does VC Look Like in 2016? I think that's probably the best question to start with.
I thought you were going to tell me what VC was going to be in 2016.
I'm a journalist. I'm not saying,
Oh,
he was
okay.
telling me I have an opinion. I have no opinions. I report what people tell me.
Yeah, I mean, interesting times, I would say, in venture. So, boy, it's just me, is it echoey? It's really echoey. Oh, anyway.
Sounds great to me.
I would say, as a starting point, if you are not a long-term bull on technology, you're kind of out of your mind, right? I mean, I would say if you take the mobile phone alone and you think about the impact of having plus or minus everybody in the world, if not the US, connected to a high-speed supercomputer with fast internet connection, personalization, payment, location and context awareness, and you think about how that's going to change pretty much every facet of our life and economy and how it already is, that alone would be enough. If you start branching out into things like machine learning and artificial intelligence or synthetic biology and personalized medicine, things like immunotherapy, for example, cancer seems curable in my lifetime, I would say, if maybe hopefully sooner than that. I think the fundamental trends that have driven venture since the inception are still there. I think in this specific moment in time, we also have some very interesting cross currents around the economic part of the cycle. So the way
People actually have to make money.
You do. It turns out that gravity is a fundamental force. I mean, actually, so Mitch Kapoor, who was on just before us, who founded Lotus, that guy started his company in, I think, 1982. In his first year, his business plan was to do $1 million in revenue. He did 53 million in revenue, massively profitable, basically since inception. Part of that was, he wasn't afraid to go and ask for a reasonable price tag. I forget what Lotus cost originally, but I think it was around $600 a copy, something like that, which was a lot of money, especially back then. I think that today that would be probably launched as a free product with the idea that you would get to some massive scale of users and then monetize indirectly. He also was competing against effectively spreadsheets and kind of manual processes, and so it was an order of magnitude improvement. I think, the competitors today, Facebook and Apple and Google and Microsoft don't look like the stodgy old incumbents that people are competing against in the 80s and the 90s. So you have very strong technology trends. You have a very different competitive environment. And then I think you've had some kind of foolishness really in the capital markets. And I would argue on both sides. I think some irrational exuberance in the last 5-6 years, something like that. And I think some bad decision making. I actually think now we're seeing the flip side of that, which is I think the public markets have arguably gotten overly bearish to the point where I would say public stocks, in particular public tech stocks, I think are objectively cheap right now on a risk-adjusted basis. So, in terms of how that affects venture capital this year, I think, and maybe giving it from the perspective for entrepreneurs rather than venture investors, I think you need to build real businesses that over the mid to long term can generate significant margins and profits, and you need to be cognizant of the capital environment as you do that. So while the technology is really the key thing and the sort of the high order bit, the capital markets will affect how you can build the companies. And I think right now we have been in a lot of the things that we've taken for granted in the last 5 years around, what are reasonable office spaces or office perks or salaries, for example, or pricing, or how you would think about pricing, or the length of time to get to positive gross margin or profitability. I think a lot of those things are going to have to be rethought, and there's going to be a lot of trauma in the short term as people adjust those expectations.
What were some of the bad decisions that you... Give me some examples. Things people were doing that they shouldn't be repeating.
Sure. Well, I mean, I can pick on some specific companies.
Do that. Pick on some companies. This is great for people.
The Wall Street Journal loves that.
Yeah.
Let me start at a high level. Okay, I was a DFJ entrepreneur myself, so I started a company in '99, which we sold in '02, and I joined DFJ in '04. So I've been doing venture for 12 years. When I joined, our best our sort of good companies that were being thrifty and frugal across our portfolio had an average burn rate of about $10,000 per FTE on average, roughly.
Full-time employee.
Full-time employee, yeah. So it was about, including benefits and everything and some allocation for overhead. So, if you sort of back that out, it meant they were paying, your sort of median mean employee was around $70,000 or $80,000. It's over $20,000 now. So it's more than doubled in 12 years. And a lot of that is driven by real estate, both for the office spaces, but also in terms of it's driven the salaries. So, salaries have had to go up here, but I actually don't think standard of living has gone up any. It's just that, what an apartment that you used to be able to get for $2,000 is now $4,000 or $5,000. So it's just more expensive. All of that is a self-perpetuating cycle where companies feel the need to pay more, and then it's inflation, right? I mean, the prices go up, and so it's been this kind of destructive circle, and it hasn't been matched with a corresponding amount of value extraction from the companies of their customers. In fact, if anything, I think there's been so much inexpensive capital that people have pushed out timeframes where they've said, I'm going to scale very quickly and maybe even at negative gross margin. Negative gross margin means you're literally losing money on every unit you sell.
But you make it up in volume.
But you make it up in volume, right. And there are times when negative gross margin, especially from a purely accounting concept, can make sense. But I think one of the problems, I think Bill Gurley actually put this really well in his most recent post. A lot of companies have looked at a Google or an Uber or some of the very best companies and drawn the wrong lessons, not realizing how idiosyncratic those companies are and how unique those perks are. Google is almost the perfect profit-generating machine that's a monopoly. And so what Google's able to do, and I would argue that some of Google's expenditures are maybe even driven by the desire to not be gone after as a monopoly, although they are in the EU right now. And so I think that, it's sort of the classic things we saw in the dot-com, the people focus on things like the free snacks and the masseuses and things like that. I actually think the bigger problems right now are people not thinking about how they create scale of margins as opposed to just scale of revenue. And also I think entrepreneurs have always had a tendency to want to compete on price, and I think the best entrepreneurs understand that price is one axis you compete on, but it's not the best one for you, and it's generally not the best one for success in the market. This was, I would argue, the part of the brilliance of both Steve Jobs and Elon Musk. They have generally gone after creating premium-priced products that are just significantly better, but they actually charge you that for that. I mean, Steve Jobs would be the extreme example. He refused to create anything that was cheap. Apple, as a result, is the most profitable company in the world.
And you guys have done well with Elon Musk.
We have.
3 different companies.
With 3 different companies, yeah. Which actually, it ties into another. If you said kind of, I think one of the criticisms of the last five or 6 years has Founders Fund, had this. We wanted flying cars. We got 140 characters, and I think it's sort of this, kind of semi-snarky way of saying that people aren't going after big enough problems, and I think that can be misleading in some ways. I would argue like Twitter or Facebook people thought was frivolous. I don't think Facebook is dominating the media industry right now. I think Snapchat may be the next one that people think was frivolous. It wasn't. But I think that there is something to be said about going after really big problems, big inspirational thorny things. And that's the brilliance of Elon. So Steve Jobs always framed the products in a broader kind of a context. Elon is going after Elon's core mission is we are killing the planet with climate change. That is primarily driven by the consumption of fossil fuels and the internal combustion engine. And so I'm going to attack that problem in every conceivable way. So Tesla is basically about obsoleting the internal combustion engine, which is the largest source of climate change emissions. Solar City, his other company, is about, okay, I'm going to attack coal, which is most US electricity today comes from coal, which is terrible stuff. I'm going to make solar inexpensive and scale solar so that our generation is also clean. And then SpaceX, which is probably in some ways the coolest of his 3 companies, I've heard him describe as planetary redundancy. So he says, in case those other ones don't work, it really looks like we might screw up this planet over the next, couple dozen to 100 years, couple hundred years. We only have one planet. It would be really nice if we had a second planet, just in case. kind of makes sense when you think about it.
You guys just raised a new fund.
Yep.
$350 million. There's actually been, even as startups themselves may have had a more difficult time raising money on the terms they'd like to raise it, VC firms themselves have just gorged themselves starting kind of late Q4, first quarter, raising new funds themselves. You mentioned Bill Gurley's post. He argued that that's because everybody's trying to get the money before the IRRs fall, before those paper gains disappear. I guess do you agree with that? Why the race to raise for the VCs right now?
I don't think it's as cynical as before the paper gains disappear. I mean, I think that's been overly negative and skeptical look at the industry. I think that people have been deploying a lot of capital very quickly, and I think that cycle times have compressed on funds. So traditionally it would be a 3-year cycle, and I think some people have been getting to 2 or even to 1-year cycles, and that's driving them back into the market more quickly. I think some of that's just a bunching of the timing on which the funds happen to raise. I do think that the one point that's embedded in that is that one thing that's separated this bubble, and I sort of use air quotes in bubble, that we've had in the last 5 years where valuations got very inflated, is that it's been what we call a dry bubble. So in 99, the companies were going public, really bad companies, frankly, 2 years old, $1 million in revenue, valued at $1 billion.
VCs were getting liquidity.
VCs were actually getting liquidity, and their limited partners made spectacular returns in that period. The returns have mostly been on paper right now. I would argue the companies are much more solid. Your typical unicorn in general still has several hundred million in revenues. But it has been a dry bubble, and I think that's a concerning thing. We've tried to maintain a very consistent pacing. We've actually taken our fund size down about 4 years ago in reaction to that. So we thought we had gotten too big as a firm, and we actually intentionally skinnied it down to a smaller number of partners and dollars.
I want to give folks out there a chance to ask some questions. Can we bring the house lights up? I don't know if we're doing that. I can't see. Is there anyone out there? There we go. Is there anyone out there that has a question for Josh? Somebody over here. Shout it out. Are you talking about like Goldman Sachs, Morgan Stanley, or the Fidelities of the world, or?
Oh, yeah. So like Wellington, I just saw Wellington led like a $10 million financing last week, which surprised me. I mean, I think that's generally going to be a bad idea. I think what you're seeing is that we're in a very low yield environment overall, and I think that the broader, kind of economy and market growth has been hard to find. And I think investors are chasing yield wherever they can find it. And I think that private companies have always offered a superior growth, and I would argue a risk-adjusted growth. But I think embedded in that is that you have to be able to appropriately evaluate that risk. And I do not think that public investors are generally well suited to do that. I think their fund sizes are incompatible. The structures, venture firms have been very carefully constructed to be long-term investors. We get capital only from very high net worth institutions. Their capital is locked up for 10 or 15 years with us. Not so much. I mean, not the people that typically invest. The typical investors in venture would be foundations, endowments, nonprofits, to a lesser degree pension funds. It's not typically an investment banker mediated process. They do put together SPVs. I think that they are more effective. The typical Wall Street economics tend to be based on like a percentage of the deal. So if you look at like Goldman Sachs structuring their mezzanine round into Facebook, or Morgan Stanley just did one for Uber, it's typically they're charging investors a 2 or 3% commission at entry. That's more of a transactional model. So while they're putting together these SPVs, I think it really only works at scale. I would be very surprised to see them going
It
successfully
is interesting
early.
how the market changed dramatically when they entered, and they compete with you guys for deals. I mean, this is another reason that VCs don't like them is they drive prices up.
Mm-hmm.
They make it harder for you guys to make your money.
Yeah, I think they're more synergistic than competing. I do think they've driven prices up. I do think that it has become unfashionable to go public. And I think what some some entrepreneurs are now learning is that when they took money from public investors, it's like they went public. So these markdowns from, Fidelity, I think were sort of a rude awakening for a lot of people. If you want to sort of
Amazing how sensitive people were about that.
Yes. Well, I think whenever you start focusing
My
on your
stock can't go
valuation,
down. It doesn't go down.
right? It never goes down; it just goes up. Yeah. When you start focusing on your valuation, that's not a good sign to begin with. I mean, you should be focused on your long-term business fundamentals. But I mean, just on the Fidelity thing, I mean, kind of hilariously, they marked down Stemcentrx by like 35%, and then the next month it gets bought for a huge multiple of their cost. So,
And in the meantime, the Stemcentrx people were just livid because they're trying to negotiate a deal.
Right.
And all the buyers are
Not
saying,
helpful.
well, does Fidelity know something that we don't?
Yes.
And
Yeah, but that's welcome to the real world. I mean, this is
public markets mark you every day. I mean, that can happen.
Young private companies are delicate things that I think do best when they do have some insulation from that kind of the vagaries of the market and short-term pressures. And I think that's part of the magic of what makes venture work well for building really dynamic companies. But at some point, you need to leave the nest and thrive in the broader market. And the broader market does things like trade your stock every minute of the day, and you'll see large swings. I mean, Apple might go up or down. Apple misses their earnings, it goes down 10%. Is Apple worth, what is that, $40 billion less magically? No, it's just, it's just the way the market works in terms of you're trading the incremental share. I mean, the whole idea that you multiply the last trade by the number of shares to get the valuation has always been kind of a sort of a dubious concept, I think. It's just sort of a shorthand.
Mm-hmm. I got to ask you one hard question.
Yeah.
Before we go. You guys were an early investor in Theranos. Very early.
Yes.
Very early.
True.
I think only in the seed round.
Correct.
So it's not like you lost a lot of money here, Tim. I think it was only in the seed round. But my question is, were there clues that you saw after the seed round that enabled you, the reason why you didn't follow on with a lot of other folks? Or
Nothing so and by the way, I don't think anyone's lost money on Theranos yet. I mean, I think the story's still to be written there. I mean, there's certainly been, you guys have written a lot of things about potential issues there, but I mean, we'll all see. But yeah, we were seed round investors, wrote a $500,000 check. Originally, the reason we put any more money in was pretty simple. They never asked us for more money. They had so much money coming at them that they just raised tons of money without us. And
what really happened there? I mean, stepping back for a second, for all the other investors that didn't, I think you guys were asking hard questions. My understanding is DFJ was one of the few people that was asking hard questions here, and maybe some other people. I mean, what really happened there?
I think honestly, they just, that's a company that's always run very independently, and they were happy to have our money initially, and we were happy to give it to them, and they literally just never asked us. I mean, I think Theranos would be on the extreme end of a founder-driven company, and I think some of the very best companies, Facebook would be a great example where that's worked out very successfully, and I think it can also be a problem if the vision is ultimately not correct. But in the case of Theranos, I think the jury's still out.
Last question. You not only the $350 million, but you were telling me you also have a growth fund. So
correct. Yeah.
What are you going to be for all the founders out here? What do you guys want to invest in?
So we are looking to do anything that has a really big vision going after a large market. From a practical standpoint, the venture fund is looking to write a check of $2 to, let's say, $12 million. And we generally are getting involved taking board seats. It's hard for us to get involved if we don't own at least 15 or 20% of a company. Our growth fund is much less constrained on ownership. They'll invest in anything that they think is a good risk-adjusted return, but they only invest in companies with at least 10 million of trailing revenue and usually much more. So it's sort of the two bookends of the strategy.
Very good.
Yeah.
Getting the cutoff sign. Josh Stein, thanks so much.
Thanks.